Hello, and on this episode of the Mortgage and Protection Podcast, we have the return of Paul Collinson from Brick to Brick Mortgage Solutions to give us a recap on remortgaging. It's great to chat with you again, Paul. How are we doing today?
Yes, I'm good, thank you. How are you?
Oh, I'm glad to hear that. And yes, all good too. Thank you for asking. So let's get straight into these frequently Googled questions that we've got here. So, first of all, and just as an overview to begin with, what is a remortgage and how does it differ from a regular mortgage?
A remortgage is somebody that actually already owns the property that's going to be mortgaged. So, say they're coming to the end of their current fixed period and they are going on to a standard variable rate, which is normally pretty high. Generally, we look at that. If, for example, for existing customers, we look up to 6 months before. So we make sure they don't go on to that very standard variable rate. We look at the best available or the most suitable option for them at that time. And then we look at remortgaging it onto that deal. So we would recommend the products for them, and we would go through the application process as per the other types of mortgages. How it differs from the other mortgages, well, I mean, with a first time buyer or a home mover, you need to find the property, and then we start the process from the beginning. Generally, with a remortgage, the solicitor process is a lot simpler and more streamlined. And that's how it differs, really. The remortgage is when you own a property and you want to another mortgage on that property rather than going on to the standard variable rate.
Okay, well, a really clear start there. So, thank you for that. Hopefully, that's making sense to anybody listening to this if it's the first time that you're doing this. And again, you've touched on this a little bit there, but how does the process of remortgaging work in the UK? And how long does it take to remortgage?
Generally, with the process of remortgaging, like I say, someone would come to me coming towards the end of a certain period, and then we would look at the process that we've just explained, and then we would, how long it takes is generally a lot quicker than if you were purchasing a property. So it can take up to 6 weeks. I have had them complete in 2 weeks, but I wouldn't recommend looking to change that late. I mean, generally we look at 6 months, and the reason we do that is because we can secure a rate and the mortgage offer is valid for 6 months. So then, if the rates are going to increase, it's fine. You've secured something between now and when the end of the current fixed period is. But if they come down, and then between now and the end of the current fixed period, we would just switch the product with that lender at the lowest possible point, so that when it completes, you're paying the least possible amount for your mortgage. As like I say, it generally takes 4 to 6 weeks. It has happened sooner, but there are complications sometimes along the way. Sometimes with solicitors it can happen, or with the lender, or they may ask for certain extra documents that we're not aware of, and things like that. Really, there may be more assessment involved, so it's always better to give yourself enough time. I'd say normally at least 2 months, but we only say 6 months because that basically keeps you in a secure position, so that you know that if the rates go either way, you're not going to be paying too much for your mortgage, and we'll ensure that you are paying the least possible at the time of completion.
Okay, well, brilliant. That gives people a rough idea there, but it depends on all the factors involved, doesn't it? And the circumstances. Okay, so let's move on then. We've got another two questions here. What are the main reasons why people choose to remortgage? I think you've probably mentioned one of them. And what factors should I consider when deciding whether to remortgage?
Yeah, I mean, the main reason why people choose to remortgage, like I say, comes to the end of the initial period, but otherwise, people do remortgage for a variety of reasons. Sometimes they may have put themselves into a debt situation. They may want to do consolidation of some of their debts into the mortgage. They may want to remortgage for home improvements. Maybe they need an extension or a loft conversion or something else. Sometimes people remortgage for personal reasons, and maybe their son or daughter may be getting married or something else. So, there are a variety of reasons why people remortgage, but sometimes people may need to take the equity they've built up over the years in their property if there's something important that comes up in their life, or something that they need to do that is needed at that particular time. And that's that one. But on terms of the factors that you need to consider, you need to make sure, the same as any mortgage really, just ensure that your credit file is up to date, because then it enables you to be in a position, or more positive position, with most lenders, and open to more of the market than if you were to not be in such so good as a situation. So even if you've got debts in the background, etc., just make sure you haven't missed any payments on those, especially in the recent last 2 years. And then that would enable us to look at more options available with lenders, really. And other factors you need to consider, as long as your income and commitments are at the right level, and then we can look at, make sure the maximum borrowing potential is still available for that. But obviously, anybody who's got any questions at all, just give us a call anytime. We can run through everything with you.
Okay, there we go. Well, thank you for that. So many reasons as to why people might be looking to remortgage there and the factors to consider. So, following on from that, then we've got another two questions here that asks, and again, you might have touched on it already, but just to confirm, what happens to my existing mortgage when I remortgage? And what happens if I don't remortgage after my deal expires?
Right. Yeah. I mean, on terms of with your existing mortgage, so when we look at the remortgage, you don't need to contact your existing lender. Well, at the beginning, it's good to do that, just to find out exactly what's left on it. But then onwards, between then and completion, you won't need to contact them at all to say you're finishing with them or anything else. Because when we've sorted the new mortgage out, all that's left at the time, a week or two before the end of the current mortgage expires, the solicitor would get your redemption figure from your existing lender, and that would be the amount that's paid off, when the solicitors change the monies around. So that would clear off the existing lender, so you wouldn't have to worry about that at all ongoing. Basically, with the remortgage after your deal expires, that's what the solicitor would do. They would ensure that the new mortgage would start on the day after your existing early repayment charge finishes on the old one, so it all goes through smoothly. But obviously, when you fill in the solicitor's details, when they send you the introduction pack, you just need to make sure that when they ask you, what day you want it to complete, just make sure it's the day after the current deal expires, and that should all go completely fine then.
Okay, brilliant. Thank you for that. So, again, some key pointers to take away there. Now, people would also like to know, will I have to pay any fees or penalties when remortgaging?
The penalties would only be if you'd made a mistake with the solicitors, on when you want to complete. Say you complete 10 days before the fixed period ends, you would be liable for an early repayment charge. But when that solicitor's completion statement comes out, you'll realize that there's a hefty early repayment charge in it, and there would have been a mistake there. But you need to find out exactly when your existing deal finishes. Otherwise, there will be penalties. So you need to find out when it finishes. So at least everything will run through smoothly, and then you can, after you've put on that form the day after the existing deal finishes, then there won't be any penalties. On terms of fees, the lender's product fee, the broker fees will still apply, but on the lender's product fee, like I say, they still offer deals that are 999 generally, or it can be zero. But like I say, when we are sourcing the best or the most suitable deal for yourself, we would ensure that the deals with the fees and without, it would cost you the cheapest. It'd be the most cost-effective deal over the 2 or 5 year deal, whatever we choose. So we'll look at all those things when they come around. Yes.
Right, okay. So, another question here asks then, how much could I potentially save by remortgaging?
That's a good one, because obviously it depends on what the rate is at that time on your existing mortgage, or what it's going on to, and then what the new one is. I mean, at the moment, like I say, this is recorded in March 2024. The standard variable rates that people will go on to at the moment are around between 8 and 10%. So, you would save a lot by remortgaging before you go on to that standard variable rate. But you could save thousands, over. So for example, you did a 2 year deal or a 5 year deal at half that rate, or even lower, and then you could potentially save thousands and thousands. I can't really put a figure on it, but you could save a lot of money by remortgaging, definitely. And those are things that's why you need to contact us, so we can run through all the scenarios with you and find out the most suitable option that you should go for.
Okay. There we go. Well, thank you for that again. And yes, just to reiterate, we are recording this in March 2024 because rates, of course, can change day by day, can't they, Paul?
Yes, they can. Yeah, yeah, yeah. I mean, none of us would have predicted recent times of things that have changed over the last few years. But yes, it's that they do change, and we're here every step of the way if you have any questions.
Okay, brilliant. Thank you. So let's continue then. The next question here asks, what documentation will I need to provide when remortgaging? So, any differences here?
Pretty much the same on if it was a purchase, really. If you're employed, and then you would need three of your latest month's pay slips, and then if you're paid a bonus, then you'd need 2 years of bonus pay slips, whether that's paid quarterly or annually. And there are lenders that may use 1 year's bonus, not many, but like I say, we can cross that bridge. If it is 1 year's bonus, then we will take the one. And if we need to use that for affordability, then that's fine. But if not, that's all good. We can look at that. But if you're self-employed, we generally need if you've been you don't need to have traded for 3 years, but if you have, and then we need the 3 years of SA 302 tax calculations and tax year overviews. If you've only been trading 1 year or 2 years, and then we will need those. We will never need more than 3 years. We do also have options if you've only been trading for 1 year, and that's something we can look into because there are a couple of lenders out there that consider that. And that's also with the ID side of things. We will need either a license or passport, along with the address proof of 3 months of your latest bank statement. So that's what we'll need on documentation side anyway.
Okay, so always good to have those at hand there. Now, another question here asks, can I switch lenders when remortgaging?
Yes, you can, but these are the options that we would look at. So we would look at the option if you stayed with the same lender. We looked at their current deals for existing customers that they have, and we will also look at the new lenders as well. So we would look at basically the option of staying with the same lender or switching. So the answer is yes, you can switch lenders, and that's what we will do to make sure that the best available, it'd be the most suitable option for you that would come up there.
Right, okay. Now, this is interesting. Will I need a new valuation or survey when remortgaging?
Yeah, even if you remortgage with the same lender, sometimes there are disadvantages of that because when you go onto their system, for example, I looked at one the other day. They bought their flat for 220,000 2 years ago. The remortgage came up as 217,000 value. They think it's worth 250. Therefore, the loan to value is lower, so the rate is higher. There are certain things, and they generally sometimes they won't come around to do a physical valuation unless you've added square meterage to the property, like added an extension or something else. So when it's a new lender, they generally would send a value around. So you're probably more likely to get more than the 217 if you think it is worth 250. So, but there is on terms of the answer to your question, I digress a little bit there, but on terms of the answer, needing a new valuation, yes, you do need a new valuation, whether remortgaging with the same lender or a new one, because whether so sometimes it'd be a physical valuation or a desktop one, but like I say, if you're remortgaging with the same lender, they generally do a desktop or automated one, and their system is basically you've just got to take that generally what they're giving you. Whereas if it's a new lender, you have more flexibility on the valuation because if they are going around there, at least they can see the actual property and not just go with the automated one. But we would need to look at the situation then, because if it's lower loan to value, sometimes it might just be an automated one. So we would look at all of that and maybe use lender that if you've had work done to the property, for example, we might need to use lender that you would prefer a physical one, which means it might be worth more. So these are all things we can look at the time.
Okay, brilliant. And no, a great example there. So it always helps to paint a picture, I think, when we're explaining these things. So brilliant there. With this next question, I think you've probably answered it. Can I remortgage if I'm self employed or a contractor? But you covered the documents, didn't you, for self employed earlier on? Any other differences when it comes to remortgaging here?
Yeah, yes. With the you can remortgage if you're self-employed or contract. That's completely fine. I mean, what I would say is, if you've been self-employed or if you're stuck in a fixed period and you're coming to the end of it and you've only been self-employed for 6 months, or you're a contractor for 6 months, and that could be an issue because you need to be self-employed for at least a year for, like I say, that one or two lenders that potentially would look at 1 year. So yes, you can remortgage, but you would need to be self-employed for at least 1 year. Or if you're a contractor, most lenders need to have 2 years contracting experience. There are lenders that I have that are okay without that, as long as you've been in the same line of work and things like that. But yes, you can remortgage if you're both of those, but we would have to look at your scenario and personal circumstances and situation there to make sure that it fits with one of the lenders that I can recommend for you.
Okay, so again, some pointers to bear in mind there. Now, we have three questions left. So the next one asks, what happens if my property value has decreased since I initially obtained my mortgage?
So, say when you bought the property and the more, say you only had 5% deposit, for example, and the mortgage values come down. Obviously, these things happened back in the market crashing in 2007, 2008. And that was an issue with a lot of lenders. They were offering more than 100% mortgages. They weren't assessing cases on income multiples. They were doing self certifications, so people would just say what they earned and it was okay, which obviously that's why we ended up in the situation we were in at the time. But I think a lot of people ended up in negative equity, which isn't the best situation to be in, because then obviously what that means, negative equity, is the mortgage on it is more than what the property is worth. So lenders just won't touch that ongoing, obviously, with that situation there. And even now, I mean, 5% there is a risk there. Generally, properties don't come down, but I can't guarantee that. We don't come down as much as that below what the mortgage amount is. But with 5%, there is still a risk of that happening. If it has decreased and you only put 5% in, and then you could be in a situation there, of course, in 2 years or 5 years time if that happens. But I think generally it's always good if you've got 10% or more in. But if it has decreased, and you've put 10%, and if it's decreased, then at least you can probably still get the 95% mortgage. But if you've only put 5% and it's come down, that could be an issue. You would probably only be able to stay with the same lender. There may be talks that maybe I'm able to have with them, and yeah, not great if it's decreased. But like I say, more deposit you've got at the start. If you've got 10%, if 5% is needed just to get on the property ladder, then a lot of people do have that. But with 10%, it puts you in a bit of a safer situation, a bit more peace of mind, I guess, if this does happen.
Okay. Okay. So again, some good points there. Now, how often can I remortgage my property? So how many times can you do this?
You can do it as many times as you want. I mean, like I say, if you're in a fixed period, for example, like I mentioned earlier, if you remortgage it while you're in the fixed period, generally you'll have an earlier payment charge that is at least 1% of the loan amount that's left on it. But yeah, you can remortgage it as many times as you want. But if you don't want any earlier payment charge, then make sure it's at the end of the fixed period. But yeah, it's limitless times really.
Okay, there we go. And then just lastly, what are the advantages and disadvantages of fixed rate versus variable rate remortgages?
I mean, there are a few of them, but to take this away with yourselves, there's a main couple of positives and negatives here. The main positive of a fixed rate is that you have stability of monthly payments. You know exactly what's going out of your account every month, and that's something to be said, really. And obviously, if rates rise, then you are secure, so you haven't got any worry there in the fixed period. The only negative is rates come down during the fixed period, then you're tied into that higher rate until the end of the fixed period ceases. So you generally have to pay an early repayment charge if you wanted to come out early during that initial fixed period. That's that one there. But on terms of available rates, like such as a tracker rate, that's where the Bank of England, the rates pack tracks a Bank of England base rate. So the Bank of England base rates, for example, that there's a positive of this if the rates drop. If the Bank of England base rates drop, and then so does your rate, also you're not tied into that, so you can come out of it at any time if you wanted to. And that's most of the tracker rates. There are a couple of them that you may be tied in with, but most of them you're not. The only negative here is if the rates rise and then your tracker rate will also increase. So you don't have stability of monthly payments there. So if they go the wrong way, and then so does your interest rates. And that's in a nutshell with those, really.
Okay, there we go. Well, thank you for that. That was really thorough. There were quite a lot of questions there that people were asking. So hopefully we've answered them all for you listening. And I'm sure we'll speak to you again on the podcast soon, Paul.
I hope so too. And thanks for your time today.
Please note, think carefully before securing other debts against your home. You may have to pay an early repayment charge to your existing lender if you remortgage. Your home may be repossessed if you do not keep up repayments on your mortgage.